I'm about to show you the single most reliable recession indicator in financial history. It's preceded every downturn since 1968. But here's the catch. Some of the smartest economists in history knew about this pattern, and still lost billions. Think about this. Warren Buffett knows this indicator better than anyone. He's watched it for 60 years. And he's never, not once, sold everything because of it. Want to know why? Because there's something about this pattern that destroyed a hedge fund with Nobel Prize winners, bankrupted traders who saw it coming, and yet made patient investors extraordinarily wealthy. Knowing this pattern without understanding its limitations is like knowing a gun is loaded but not knowing there's a timer on the trigger. In this video, I'll reveal 3 things that will completely change how you understand markets. First, the indicator that's preceded every recession since 1968. Second, why long-term capital management, with literal geniuses on staff, understood this pattern and still collapsed. And third, what Warren Buffett actually does when he sees this signal. Hint, it's not what you'd expect. By the end of this video, you'll understand both the power and the danger of this controversial pattern. But first, we need to go back to 1928, when this all started. It's the Roaring '20s. Everyone's getting rich in the stock market. But in the bond market, the boring part of finance nobody pays attention to, something strange was happening. For the first time in modern history, banks were paying more interest on 6-month loans than 10-year loans. It made no logical sense. It was like a restaurant charging more for a small pizza than a large one. Economist Irving noticed this. He was brilliant, basically invented modern monetary theory. But here's what happened next that nobody talks about. He saw the pattern, understood it was a warning, and then 3 days before the crash declared stocks had reached a permanently high plateau. The market fell 89% over the next 3 years. So what the hell happened? How did someone so smart see the signal and still get it completely wrong? The answer reveals everything about why this pattern is both powerful and dangerous. Let me make this real simple. When you lend money, you charge more interest for longer time periods, right? Lend for 2 years, charge 3%. Lend for 10 years, charge 5%. Basic risk management. But sometimes the entire US Treasury market flips this logic upside down. The 2-year starts paying more than the 10-year. It's called a yield curve inversion, and it's about as natural as water flowing uphill. When this happens, it means the smartest money in the world. We're talking trillions of dollars from pension funds, insurance companies, sovereign wealth funds. They're all so terrified of the near future that they're accepting less money just to lock in long-term safety. Now here's where most people screw up. They think this means sell everything immediately. But later in this video, I'll show you why that's exactly the wrong move. First though, you need to understand what happened in 1998 that changed everything. Nobel Prize winners Myron Scholes and Robert Merton on staff. These guys literally invented the formulas Wall Street uses. They knew about yield curve inversions. They had models that tracked every basis point movement. They saw the pattern in 1998 and positioned for it perfectly. Then Russia defaulted on its debt. See, LTCM had one fatal flaw. They were leveraged 30 to 1. For every dollar they had, they borrowed 30 more. When Russia defaulted, something their models said had a probability of basically 0. Their positions moved against them by just 3%. But 3% times 30 equals bankruptcy. The Fed had to organize an emergency bailout. The global financial system nearly collapsed. All because the smartest guys in the room forgot one simple rule. The market can stay irrational longer than you can stay solvent. This is why understanding the pattern isn't enough. You need to understand how to survive it. So what exactly did LTCM miss? Let me show you the actual pattern. This is the yield curve. Normal looks like this indicates upward slope, short rates lower, long rates higher. Makes sense. But when it flips like this indicates downward slope, that's an inversion. Short rates are higher than long rates. Now watch the timing. This is what destroyed LTCM. 1928. Irving sees the curve invert. He waits. And waits. 6 months pass. Markets still rising. 10 months, new highs. He declares stocks have reached a permanently high plateau. 3 days later, Black Tuesday. The market falls 89%. Here's 1973. The curve inverts in June. For the next 11 months, investors who sold missed a 14% rally. Then October 1974 hits, 48% crash. February 2000. Curve inverts. The Nasdaq kept screaming higher, gaining another 17% in just over a month. 13 months later, Nasdaq down 78%, $7 trillion gone. See the pattern? The inversion isn't a light switch. It's more like a time bomb with a random fuse. 2006, curve barely inverts. The market rises 15% over the next year. Then 18 months after the inversion, Bear Stearns implodes. 6 months later, Lehman dies. 401ks cut in half. Being right at the wrong time is the same as being wrong when you're leveraged 30-1 like LTCM. So what does Warren Buffett do when the curve inverts? 2006, curve inverts. Buffett bought Burlington Northern Railroad. But he's also sitting on $37 billion in cash. Not because he's scared. Because he's patient. By 2008, when everyone else is forced to sell, Buffett's writing $5 billion checks to Goldman Sachs and getting 10% interest plus warrants. The lesson? He used the inversion as a signal to prepare, not panic. John Paulson saw the same inversion in 2006. But instead of just shorting the market, he did homework. Hired analysts. Read thousands of mortgage documents. Found ninja loans, no income, no job, no assets. His fund made $15 billion in 2007. Not because he traded the yield curve. Because he used it as a starting gun for actual research. After studying every inversion since 1968, here are 3 truths nobody wants to hear. Truth number 1, you can't time it. 6 months? 2 years? Your guess is as good as mine. In 1980, recession hit in 6 months. In 2006, it took 24 months. If you can't handle that uncertainty, you'll get crushed. Truth number 2, sometimes it's wrong. 1966, curve inverted, no recession. 1998, brief inversion, no recession. If you panic every time, you'll miss decades of gains. Truth number 3, it might stop working. When everyone knows the secret, it's not a secret anymore. The more people watching this pattern, the more likely it changes. That's how markets evolve. So if you can't time it, it's sometimes wrong, and it might stop working. What's the point? Here's what the best investors actually do when they see an inversion. First, they check their mortgage. If you've got an adjustable rate and a recession hits, you're screwed. They lock in fixed rates when they can. Second, they look at their job. If you work in construction, real estate, or luxury goods, industries that tank in recessions, maybe you save more cash. If you're a nurse or utility worker, you're probably fine. Third, they get greedy. Not selling greedy, buying greedy. They make a shopping list of great companies they'd love to own 50% cheaper. Then they wait. Fourth, they keep investing. Dollar cost averaging through a recession is how regular people get rich. You buy all the way down and all the way back up. Notice what's not on this list? Panic selling. Market timing. Going to cash. There's one final insight that pulls all this together. Here's the billion-dollar question nobody asks. If this pattern is so reliable, why isn't everyone rich from trading it? Remember our Nobel Prize winners at LTCM? They knew this pattern cold. Had supercomputers tracking every basis point. Lost $4.6 billion in 4 months. Here's what actually killed them. They bet the farm on being right. Leveraged 30-1. When Russia defaulted and markets went haywire for just a few months, they couldn't survive long enough to be proven right. It's like knowing winter is coming but freezing to death in October because you bet your coat on it being December. The real secret isn't predicting the future. It's surviving whatever happens. So let's cut through the BS. Here's what 96 years of data actually tells us. The yield curve inversion is real. It's preceded every recession since 1968. It's happening right now, or it isn't. You can check yourself in 5 seconds on Google. But here's what separates the Warren Buffetts from the blown-up hedge funds. Buffett sees the inversion and buys more ammo. Most people see it and panic. The survivors prepare. The casualties predict. Nobody knows if this pattern will work next time. Nobody knows if the recession comes in 6 months or 24. Nobody knows if it'll be a speed bump or a cliff. But now you know what to watch. More importantly, you know why patience beats prediction every single time. This pattern isn't a trading signal. It's a reminder that markets are driven by fear and greed, that cycles are normal, and that the best opportunities come when everyone else is terrified. Your homework? Google US Treasury yield curve once a month. Not to trade it, just to understand what the smart money is thinking. Drop a comment. What patterns have you noticed in markets? What did this video make you think differently about? And remember, I'm just some guy on YouTube showing you historical data. This isn't financial advice. Don't bet your retirement on any pattern, indicator, or YouTube video, including this one.